You know, Starbucks. We all do. That green siren is practically on every street corner on the planet. But today, we're going to look past the frappuccinos in the morning rush and dive right into the numbers to see what's really brewing under the surface.
So, let me ask you, what do you think is the single biggest threat to Starbucks right now? If you've been watching the news, your mind probably jumps straight to unions, labor costs, that kind of thing. But what if I told you the real story, the much bigger risk, is actually hiding in plain sight in their financial reports?
For years, the story we've all been told is that Starbucks is this unstoppable global growth machine, right? Just constantly expanding its coffee empire from its home base in Seattle all the way to Shanghai. And, to be fair, for a long time that narrative was absolutely true.
But here's the thing. While all the headlines are focused on those labor disputes, they might be missing the forest for the trees. Because the financial data, well, it tells a very different, and I think much more important story about where this company is headed.
And that brings us to the absolute core of this analysis, what we're calling decaffeinated growth. The idea is simple. The data is showing us that the high caffeine buzz of rapid expansion is starting to wear off. Starbucks is entering a much more mature and much slower phase of its life.
I mean, for all the talk about a global empire, the reality is that Starbucks is, and has been for years, an overwhelmingly American company. Look at this. For years, more than 70% of its revenue has consistently come from just the United States. So that global growth engine story, the numbers just don't quite back it up.
And it's not like another region is about to pick up the slack. This slowdown is happening everywhere. Just look at the trend lines for the US, China, Japan, Canada. They are all slowing down and all pointing in the same direction, towards zero. There isn't a single high-growth region left to carry the company forward.
Okay, so when your sales growth on the top line starts to slow, that pressure inevitably trickles down to your cash flow. So let's follow the money and see what that squeeze actually looks like.
Now, at first glance, the cash situation seems okay. The company's cash from operations, that's the yellow bars you see, is growing. But the blue bars, that's what really matters to investors. That's the free cash flow, the actual spendable cash left in the bank after you pay to build and maintain all those thousands of stores. And that number has been basically flat for almost a decade. So where on earth is all the money going?
Well, here's your answer. If you follow the cash coming from operations, you can see a massive chunk of it, we're talking nearly $3 billion, is immediately siphoned off into CapEx. That's all the money they spend building new stores and renovating old ones. This creates this constant nagging trade-off. Do you keep the stores looking fresh, or do you have money left over to give back to your shareholders?
And this is where that squeeze gets really tight. Over the last 3 years, Starbucks has been jacking up its dividend payout by over 8% a year. But look at the earnings growth that's supposed to support that dividend. It's a tiny 0.3%. You just can't grow your payout that much faster than your earnings for very long before something has to give.
And all of this pressure is shrinking the company's financial safety net. Its interest coverage, which is basically just a measure of how easily it can pay the interest on its debt, has been steadily falling. It's dropped from a really comfortable level of over 7 times earnings down to around 5. Now, that's not a crisis yet, but it means there's a lot less wiggle room than there used to be. So, let's recap. We have slowing growth, and we have squeezed cash flow. That's the decaf part of the story. But what about the stock price? Well, it seems to be priced like a triple-shot espresso, incredibly strong, and assuming a whole lot of future energy that might not be there.
And when you stack Starbucks up against its peers, this high valuation really jumps out at you. Each one of these bubbles is a major restaurant brand. And way up at the top, with a PEG ratio of nearly 3, is Starbucks. The market is valuing it far, far more richly than almost any of its competitors.
And just so we're all on the same page, the PEG ratio is just a simple way to see if a stock's price is justified by its earnings growth. A common rule of thumb is that any ratio over 1 might be a red flag that a stock is getting overvalued. And as we just saw, Starbucks is sitting near 3.
It's not just expensive compared to its peers either. It's actually expensive compared to its own history. Even with all the slowing growth we've just walked through, the market continues to price Starbucks well above its historical average valuation. That's the red line there. That tells you a lot of optimism is still baked into that stock price.
Okay, let's tie this all together. The real risk for an investor here isn't about any one specific headline. It's about this fundamental and growing gap between how the market perceives the company and what the financial reality actually is.
So the takeaway is this. The story of Starbucks being a high-growth disruptor is fading. The company's cash flow is being stretched thin by a dividend that's growing way faster than the business itself. And yet, the stock is still being valued like a high-growth company, not the mature one it's become. That disconnect, that is the real story.
And that leaves us with this final thought. The biggest risk here probably isn't the disruption from labor strikes that's grabbing all the headlines. The bigger risk is the complacency of investors who might still be paying a premium for a growth story that has already been, well, decaffeinated.